Have you ever wondered how to get a home loan being self-employed? Well, in today's video, I'm going to show you exactly how to do that in 4 different ways. Guys, stay tuned. Welcome back to the channel, guys. If you're new to the channel, I'm Credit Coach Q, and I created the first cloud-based software that allows you to put your credit repair expenses to on hand. In today's video, I'm super excited because I have a banger. In today's video, I'm going to teach you guys how to get a home loan being self-employed in 2022. But before we get into the video, guys, please like and subscribe to the channel. It helps us actually grow within the YouTube audience, and it helps us actually get into the algorithm, and it helps YouTube push this content to a wider audience and allows us to keep these lights on. Guys, please like and subscribe to the channel. Now, let's dive straight into the meat and potatoes of this video. Now, this video, as you can see, I have a special guest to the right of me. I've actually brought in a real estate professional to actually break these sequences down for you guys. Now, I've gotten a lot of responses in the comment section asking how to apply for a home loan being self-employed. I've been going through the ringers. This video is going to give you the detailed description of what you need to be self-employed and actually take your finances and actually to the underwriter and get approved. So now let's introduce my special guest. This is a loan officer who cares. He is a loan officer in the Houston, Texas area, and he's going to give us the breakdown of the home loan structure for self-employed. Welcome.
Thank you so much.
No
it's my
problem.
pleasure being here. Sheldon Farmer Jr., aka Loan Officer Who Cares.
Yes, sir.
NMLS number 111-7854, and I am an equal housing lender. As Credit Coach Q just said, I'm here to explain the process to you, how to get into a home being self-employed. That's a hurdle sometimes you guys run into, but we're here to help you guys overcome that obstacle. Can you dig it?
Can you dig it, man? That's awesome. That's awesome. All right, so give the people a little quick description about you, so they can have a little credibility behind the topic today. We're gonna make it really quick. Tell them a little bit about yourself. Tell them how long you've been in the real estate market, and tell them how long you've been in the industry. And tell them, give us a quick description about you.
All right, perfect, man. Great question. My name is Sheldon Farmer Jr. As I stated, I've been in the mortgage industry since 2000. So I have over 20 years experience in the industry. I've been a licensed loan officer since 2013, and so I have a lot of experience in the industry. I work secondary marketing, I work capital marketings, I work the trading desk, I work the lock desk, I work the processing side. So I work different angles of this industry, so I know how to move a loan, and I know what a good loan looks like.
Man.
So structuring a good loan is my forte.
Forte. Awesome.
Yes,
Awesome. And you in the Houston area? Have you always been in the Houston area?
Yeah. Cypress, Texas is the office, but Houston is, yes. I've always been in Houston, Texas. I've been in Houston since the year of 2000.
Okay.
Yeah.
Me and Sheldon have been knowing each other for quite some years now. We have partnered up. We have done home buying workshops, teaching first-time home buyers how to get into home loans. We've been doing it for quite some time. Like I said, I've been getting a lot of comments about self-employed individuals getting approved. So I just wanted to, shed some light on that actual structure for approval. And let's talk about it. Let's dive straight into the meat and potatoes, guys. Let's talk about how to get a home loan first. So it is some key components of getting a home loan first and foremost prior to the self-employed aspect of it. Am I right?
Yes.
Okay. So the main components that to get a home loan is credit, obviously.
Yes.
It is debt to income ratio, and it's employment status, correct?
Yes, sir.
Am I missing anything?
Stable employment.
Am I missing anything?
No. Yeah.
Okay. So give us a quick rundown on the requirements of getting a home loan outside of self-employed, and then we'll go directly into the self-employed.
Okay, perfect. Great question. The easy way to get into a home loan, just a regular basic financing, we look for 2 years of employment history, whether that's 2 years of self-employed or 2 years of just regular employment history, right? And then also if you just graduated from college and you've been working and you went to college for the particular field that you're employed in now, we just use 1 year of employment history because your college can count as a year of your employment history.
Wow.
Okay, yeah, we can use that, all right? And then also also what we need is that we look at the income. We look for 2 months of your bank statements, 2 months of your most recent pay stubs, look for your ID. We just look for basically the ability to repay and the stability. That's what the underwriters look for. And anything questions that, any gaps within that kind of breaks that up, we just want to have that question answered with a letter of explanation, things of that nature. So just look at, can you afford the home, and look at your ability to afford the home.
Awesome. So it's different structures of home loans.
Yes.
We have FHA, we have conventional,
Yes,
we have USDA, we have VA. The most normal out of the three is probably FHA.
People like FHA, they see it as a common one because FHA allows for a higher debt to income ratio, 55, 56% in some cases. So a lot of times people like FHA because it's easier to get into and you have to pay 3.5% down. So it's a lower down payment. But also what a lot of people don't see sometimes though is that they have conventional loan options as well. If you're a first time home buyer, and also if not being a first time home buyer, you can pay 3% down to get into a home.
Oh, wow.
Conventional financing.
Oh, wow.
Yeah.
Okay. So what's the minimum credit score?
The minimum, they have options out here that were 500 credit score, 10% down, 580. With my company, we look for at least a 600 credit score with assets. 640 would be the sweet spot for the best rates and prices. But if you have a 600 credit score and have assets, things of the nature, we'll look at the file and see if it makes sense. So my company's 600.
Okay, so is that 600? Because we have 3 credit scores.
Yes, FICO score, mid FICO score.
So that's the mid. So
yes,
let's explain the mid score really quick.
Okay.
The mid score is the average between all 3 of your scores. So loan officers, they typically don't like to go off your highest score, then they don't go off your lowest score, they go off your middle score. So for instance, if your Equifax is 500, if your Experian is 501, and if your TransUnion is 502, your TransUnion is your highest, 502, your lowest is your Equifax 500, and your mid score is Experian. Experian is the 501, and that is the score that they go in the range. And that score can vary from month to month. Your mid score could be TransUnion 1 month, and it could be Equifax the next month, correct?
Yes, correct.
Okay, so that is what a mid score is, and you want to make sure that your mid score is ranging between a 600 to 640 to even get in the door. So we want to make sure that we can get pre-approvals prior to even wasting professionals' time, anything like that. We want to make sure that we get as much structure with the financing already before we can even really dive directly into the underwriting process, right?
Yes, we want to make it a solid deal. And also when we use the mid FICO score, we use a lower of the 2 borrowers. So if you have 2 borrowers on the file, if one borrower has a lower mid FICO score than the other one, we use a lower of the 2 for qualification purposes for rates and pricing.
Oh, wow. That's awesome. Yes. Okay. And DTI. So I want to give guys a quick description of debt to income. So your debt to income is your income that you actually bring in versus the expenses that you actually pay out, right?
Yes.
So if you bring in $1,000 and you spend $500 a month on bills, what's your debt to income? That's 50%. And he just said the minimum debt to income ratio for getting approved is what?
You need the minimum is 43. The minimum around 43, but the maximum you can get up around 55 or 56. With FHA, VA, they allow a little bit higher debt to income ratio.
And how long you have to be employed?
2 years.
2 years. Okay.
2 years.
So that is the minimum basics of getting approved for a home loan. Credit score 600 to 640 sweet spot, mid score. We had the debt to income ratio between a 55% is the highest that we're able to give, and we have the 2 years of employment history. So I wanted to break down the nuances of any home loan prior to getting a home loan with self-employed. So now we want to transition over to the self-employed aspect of the approval, and I wanted to really give Loan Officer Who Cares the floor when it comes to explaining how they structure these underwriting deals for self-employed, because it's completely different from a person that actually work, right?
Yeah, it's totally different.
Okay.
It's totally different.
Yeah, I'll break that down for us. So what is the 4 structures that you can use to get approved?
The 4 we want to use is going to be, you can use a regular 2 year of 1099s. Okay, we can use 1 year of your 1099s. We can use 12 months of bank statements, or we can use 24 months of bank statements. Okay. So those are the 4 different options.
Okay. So let's talk about the first option first. All right. How does that breaks down?
How the first one breaks down is that we look at say you call me and when you're self-employed, right? We run an application and we see you're self-employed. I look at your tax returns, your 1099s with all schedules and everything for the last 2 years, 2021, 2020 in this particular case, right? We look at line 31. That's the available income that you have left that you show that you made with your business, right? After all your write-offs and depreciation, things of that nature, right?
Okay.
So we look at line 31 plus depreciation. We look at that for 1 year, and then we look at the same thing for the next year. We take those numbers, divide them by 24. We average them out because we're averaging out a 2-year period, correct? And whatever we use at that shows as your monthly gross income using those 2 years. Okay. We use those. That's how the 2-year works.
Okay.
All right.
All right.
So you want to go into the 1 year one?
Yeah, let's go. Yeah, transition over.
Okay,
Yeah.
and the 1 year one, how the 1 year one works is that we spoke of is that if you've been in the same business for 5 years, that business for over 5 years, we can use 1 year of your returns for your income.
So I'm gonna stop you right there.
Go
So
right ahead.
the difference between the 2 years
Yes.
of using your tax returns is you can be in business. You have to be in business for 2 years,
Yes.
and you can use a 1 year if you have been in business for 5 years.
Same business for 5 years.
Okay.
The same business. Self-employed in the same business for 5 years.
Okay, so you get an incentive for being in business longer,
Yes.
where you can use one
Yes.
tax return versus two.
Because sometimes people write off a lot on the taxes and stuff, so they don't have a lot left, as far as the income is concerned. So sometimes they may have had a better year this year than last year, right? And so we use that 1 year for that. And then what we use is that they have to have a 43% maximum debt to income ratio because we use is what they call Freddie Mac underwriting versus Fannie Mae underwriting. So that's where that 5 year comes into play, and 43% debt to income ratio maximum to go that particular route. But it is a good option if you have more income 1 year than the year before.
Awesome. All right. So yeah, let's transition over to the third one.
Okay, cool. And the third option that we have here, what we call bank statement options, all right? 12 months bank statement. Say if you look at your taxes and I say, hey, Mr. Q, Credit Coach Q, business did well, but you wrote off a lot. Okay, well, hey, man, my business is rolling. I have a lot of income coming in with this business. It is rolling great. I'll tell you what we can do. Give me your bank statements.
Okay.
Let's look at 12 months of your business bank statements. I'm going to shoot those over to my investor. What they're going to do is they're going to average your deposits, okay? Your 12 months of your deposits, take out anything that doesn't, pertain to your business expenses, your business deposits, right? Then they'll send me an email back saying, okay, here's what we have. Here's what we showed their income is for that month, for monthly gross income.
Welcome.
That's what we set the sales price and everything of the home based upon that monthly gross income.
Man, that's
Okay?
awesome. That's
Yeah.
awesome.
So that's the option for the 12
Okay, so the first two options is for tax return.
tax returns,
Yeah.
1099 full tax returns, and our schedules.
Okay, so let's rewind and do a full recap,
Okay,
man. So,
okay.
for the people in the back.
For the
okay?
people in the back,
All right,
man,
so-
I know I talk
so-
fast sometimes too, so I don't want to lose nobody.
Okay. So the first one is for for tax returns.
Tax returns, 2 years.
2 years, and the second one is for tax returns 1 year.
1 year.
5 years in business.
Yes, sir.
And the third one is for bank statements
12
12 months, and they take your deposits into question.
Yes.
And they minus that from your DTI income coming in,
Well,
right?
yeah, they look at the deposits and they determine which business deposits are, and they take out anything that's not business deposits, and so they come up with an average of that for your monthly gross income
Awesome.
based upon your 12 months of your business bank statement.
Awesome.
Also, personal bank statements options. So they have business and personal options, just depend on the investor that I use.
Okay. What's the fourth one?
The fourth one is 24-month bank statement option. Like say, we have 2 years of the business, everything is working good, because say the 12 months doesn't give you enough income. So we go with 24-month bank statement option, and we look at that. And those are as low as 10% down options. So you can pay as little as 10% down to get those, to get those bank statement options. So they look at the 24-month, same premise as the 12-month, average them out, send me the email back, and then we go from there as far as your monthly gross income. And that's what we plug into the file and base your sales price of the home you need to be shopping for based upon this income that we've derived from these 12 or 24 months of bank statements.
Okay. So basically, you're saying that you have to be in business for 2 years, basically.
Yes.
You have to be in business for
to
2
meet
years.
that 2 year time frame.
Okay. And with that being said, what is the best option out of the four?
The best option out of the four is that what fits your situation. You know what I mean? Though one of the cheaper rate would be the 2 year tax return option,
Okay.
or even a 1 year tax return option if you have enough income, because you can do regular Fannie Mae pricing. The 12-month and the 24-month bank statement that are options is what we consider non-QM products, non-qualified mortgage, meaning that they're not sold through Fannie or Freddie Mac on the open market. So the rates are a little bit higher for those. You're not getting that premium rate, but it is an option when you need an option. You see, because you
Right.
can always refinance later on down the line as business picks up, as you have those 2 years of the great income.
That's awesome.
You can go that particular route.
That's awesome. So let's do some fact questions. Okay.
Okay.
So what do you feel like is one of the biggest misconceptions of getting approved for a home loan? Like, what do you think is something that you see, something common that you see a lot of individuals do, that you feel like if you say it right now, you will bring a lot of value to the person to stop doing it in the future if they're a first-time home buyer?
That a lot of times people think that they need 20% down to get into a home.
Okay.
You don't need 20% down.
Okay.
And also with down payment assistance programs, even if someone gives those funds, you still need cash to close. You still need closing costs. You still need your earnest money, your down payment money. So those things you're still going to need. So I would say that even if you get someone to give you money, still have some skin in the game yourself, because when you get this home, it's always going to be something. So you definitely want to have your finances in order and have as much as your debt paid off as possible before you apply.
Okay, so we didn't talk about down payment.
Yeah.
We didn't talk about down payment. What is the down payment requirement for a deal like this for a self-employed person?
10% down. We talk about 10% down or 20% down. Just all depends on which investor that we use. With a 660 or a 680 credit score, you can get in as little as 10% down for the bank statement loans.
So that's just for the self-employed.
The self-employed bank statements, yeah.
So the self-employed have to put more down.
They have to put more down because remember we talked about it's a little bit more riskier product. It's a little bit more, it's a non-qualified mortgage product. And so because they can't sell these loans and benefit them from selling them on the open market with Fannie and Freddie, they have to recoup their costs other ways, which is a little bit higher rate, discount points, things of that nature. So again, it's not the cheapest option, but is an option if you need one. And especially if you're renting, it's going to work out for you anyway.
Oh, wow. So let me ask you this. If a person has a business and they are employed as an employer of their business, does that still categorize as a self-employed person, or is that W-2?
It's self-employed, but then also if they're paying themselves, now depending on how they're paying themselves,
right?
Because they can be self-employed, but they can own the business, but also be paying themselves 1099. Or they can pay themselves W-2. You know what I mean? We just need to have the tax returns and everything to look at it and try to determine how we want to determine it. Because if you're doing W-2, then of course you would go the regular Fannie and Freddie route.
So you can have a business, pay yourself a W-2, and go the same conventional route, correct?
If you have the W-2 and you have the 2-year history and stuff. The thing about it though is that we have to look and see your ownership percentage in the business. And if you own more than 25% or so of the business, we still have to count some losses of the business against you. So we have to keep that in mind as well.
Man, this is interesting, man. This is a lot of meat and potatoes, guys. Please remember to like and subscribe to the channel. All right, man. I got a few more questions for you.
Okay.
We're gonna wrap it up. Okay. So the self-employed individuals have to pay a higher down payment. And you say the minimum is 10%, right?
Yeah. Yes, sir.
The minimum credit score is around 600.
660 for the self-employed.
For the self-employed.
Yes.
Okay, so the self-employed got to have a 660.
Yes, they want a higher game because they want to be able to see your ability to repay. Remember, we want to see we're doing the business, they're doing risky loans. We want to make sure that you're a good risk, good ability to repay.
You hear what he's saying, guys? What do we talk about all the time on this channel? I tell you guys all the time that you have to mitigate your risk. And I've said that through numerous of videos. This is an actual loan officer, and he's telling you what he wants. He wants to make sure that the risk factor is not there, is not substantial. So any type of approval for financing, whether it's a car, home, boat, business funding, whatever, you have to make sure that your risk factors are extremely low. So you have to have a 660 for the self-employed, mid score.
Yes.
You have to have 10% down.
Yes.
What's the DTI for that?
Looking at it, can go up to about 45. You can go up to 50. In some cases, just all depends again on which investor, and that'll be determined on the loan to value, credit score, depending on what direction we want to take.
Okay. So, guys, if you have any derogatories on your credit report, please go over to My Credit Approved. Like I said, this is the website that I generated that allows you to put your full experience into your own hands. You can remove literally anything: late payments, bankruptcies, collections, charge-offs. Guys, you name it. Go over to mycreditapproved.com and get those derogatories off. Guys, I teach all the time how to get these assets with bad credit, but like I tell you, you're going to eventually have to fix your credit to actually get into these approval processes. So guys, if you have any issues, please go to mycreditapproved.com. Did you have anything else you wanted to say to the people?
No, I just wanted to say, if you guys in the state of Texas seeking a home loan, my name is Sheldon Farnberry. My website is www.loanofficerwhocares.com, 281-731-0673. Licensed in the state of Texas, so I can help you guys out and get you guys done and make the process simple. And I also have a book on Amazon called Let's Get Your Home Loan Ready.
Let's get it.
Get that book.
Let's get it. And what's your social medias?
Social media is at Loan Officer Who Cares on Instagram, and Loan Officer Who Cares on social on Facebook as well.
Okay.
Just find me there.
Awesome, guys. Till next time, please take care of your credit and please take care of yourself. Credit Coach Q out.